Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Mike Kramer. Now, Mike is the CEO and founder of Freed by Real Estate, a private equity real estate firm specializing in value add multifamily properties. Now, Mike's journey began back at a young age after a family tragedy left his family in a financial crisis, sparking his determination to build wealth. Now, over the years, Mike has bought and sold several businesses, gaining valuable insights. In 2016, a life altering accident caused Mike to lose vision in one eye. And ultimately, this experience shifted his focus from merely building wealth to creating passive income. Now, with over 20 years of real estate investing experience, Mike is fully committed to helping others achieve financial independence through real estate, ultimately offering investors the opportunity to build a generational wealth. And so, guys, with that, I'd like to welcome our guest for today's show, Mike Kramer. Mike, how you doing?
Good, Kevin. Thanks for having me.
Yeah, excited to have you here. Excited to talk shop and just again dig into your background a little bit. You've done a number of things over the years. It sounds like you've been in real estate now for over 2 decades. But so I gave you the brief introduction. Surely there's a lot more to the story, more to fill in the blanks. So I'm going to pass it back to you. And if you would, Mike, just tell us again a little bit more about yourself, your background, and how you found your way, given this life altering experience into the real estate world.
Yeah, well, I appreciate that, Kevin. I'll never forget the day. It was in 1992 where my mom came to me. I'm the youngest of her five boys. She also has five girls. So I'm the youngest boy in the family, number nine of 10. And she told me, Kevin, that she didn't have $600 to dig my father's grave. And the
Oh
night
boy.
before, he had passed away in our living room, and he had a 3-year battle with cancer. So on top of grieving this loss of my father, I see this look of terror and concern. And, my mom was freaking out. Like, she didn't know what to do. And that really upset me. It really challenged my view of my father, because on one hand, my hero had just died, somebody I looked up to and actually wanted to be. And on the other hand, I see the mess that he left my mom in, which happened in an instant. Up until that moment, I thought everything was good. My dad was a business owner for 40 years in our small community, very well known and respected. To this day, Kevin, I'm a 50-year-old man, and I can go back home, and in my small town, they still call me Cy's boy. My dad's name was Cy. So to give you some perspective, his
Yeah.
reputation was amazing, but he died broke. And I promised to myself on that day that I would never let that happen to anyone in my family again. And so I set off on a journey to figure out, I wasn't sure how, but I set off on a journey to do so. And the very first step was to get a teaching degree, which makes total sense if you want to create wealth, right? Well, I ended up quitting teaching very quickly because I realized there's no money in it. My passion to help people and serve others still is with me today. It's just manifest in different ways. But I ended up starting a small business. It was a franchise, and very, very quickly realized that that was the path for me. In the first year, Kevin, I was the fastest growing franchise in the system. The second and third year, I was the number one franchise sales operator out of 150 locations in the US.
Wow.
And at this time, I'm 28 years old. And so I remember standing up in front of the room at the national convention, speaking to a room of 300 people, and thinking to myself, most of these people have been in business longer than I've been on the planet. And now here I am with the guy in the front of the room telling him how to be successful. And I was like, I felt like I made it. I was like, I'm the hero. Everyone's following me around and wanting to talk to me, and it felt great. Um, but the reality was that journey, being so exclusively focused on building a business and creating wealth, cost me my family, my wife and my kid. I had 4 kids with my wife. I have 4 kids with my wife, now ex-wife. And that experience was to the exclusion of them. And I had this weird kind of parallel moment where I flash back to, after the divorce, I flash back to the day my dad died. And I remember thinking I had done all of this for my family. And while I righted the financial wrong of my father, I actually abdicated and failed
Mm.
him in the reputational side of it, in the legacy side of it for my family. And it just really, really brought me to my knees. And this would have been in 2011 or 2012, where this happened. And I remember thinking, great business guy. I solved the money problem, but my family's in shambles. What did I do wrong? And I felt like a failure to a degree that I've never, even worse than how I felt about my dad's failure, because now this was mine. And it was in that moment where I kind of gathered myself and said, if I'm going to do something in the future, it has to have this dual mandate. One is I need to create wealth, but I also need to make sure I honor my family. So
Hmm.
today, Free by Real Estate was founded on those principles. Those two mandates are really what guide us today. And so we have 12 family members that work full time in the business. Three of my four kids are full time in the business, and everything we do is a family related business. So if there's other families out there looking to create wealth through real estate investing, our approach to it is very family centric. So what that translates to is we don't like to have an individual invest, a check writer, although as you know, as a capital raiser, having a check is critical, right? It's important. But if it doesn't come with the engagement of the family, we really can't serve them well. So
Hmm.
we invite husband and wife and children oftentimes to join us at our events. We have programming for the kids. We have programming for husband and wife, because we've learned that without that alignment, I learned the hard way, without that alignment, wealth building is empty. And so we want to build wealth, but do it with a family. So that's what we focus on today.
Well, that's powerful, my friend. I appreciate you sharing that, and very obviously a very vulnerable moment in your life, and again, just appreciate you being open about it and sharing, some of those challenges that you went through. But yeah, I would love to, if we could, before we move into what your business looks like today. I'm just curious. I guess first and foremost, the franchise. What industry was that in, and what business?
Yeah, it was called, are you familiar with Ace Hardware now?
Yeah.
The
Uh-huh.
Ace Hardware store. So they have a
Yeah.
handyman service called Ace Handyman. And
Okay. I did not
before
know
it,
that. I did not know that part. I've never seen one of those. Maybe we have them around here. I've just never seen one.
well, it's a recent acquisition. So I mentioned Ace because now it's a family or a household name. Prior to being Ace, it was called Handyman Matters, and I was a franchisee. I actually had 5 locations in Nebraska, South Dakota, and Arizona. Sold
Okay.
those in 2008.
Interesting timing for the sale.
Yeah, it was. It was. I think that was a divine appointment, my friend, because I wasn't planning on selling it. That's sort of a fun little side story. I actually was going through some business coaching on how to scale and grow my business, because the challenge with that model was it was an owner operator
Hmm.
model. And so it was a great lifestyle business, but I didn't want that. I wanted to scale. And so I was getting coaching to help me level myself up to scale the business. And at the end of the program, as a 2-year program, the guy my coach gave me a free business valuation with a local business broker. So I go in the office, Kevin, and I bring him all this stuff. And I had sent him financials ahead of time. And in about an hour into the meeting, he looks at me, he said, "What do you think your business is worth?" And I said, "I don't know. I have no idea." He said, "Well, just give me a number." So I threw a number out and he said, "Mike, I can sell your business for 3 times what you think it's worth." I said, "No, you can't." He said, "Yeah, I can." He slid a contract across the table. Kevin, I signed the contract without even telling my wife. 90 days later, my business is sold for 3 times what I thought it was worth. It was a life-changing moment. I remember going into the attorney's office, the big long conference table, circled with papers. I went around and signed my name, how many ever times that was. And I walked out of there with a big check, a big physical check, but big numbers. And I went right to the bank and paid off our house and did some other things. But that was a life altering moment and
That's
really helped
exciting.
set. Yeah, it was great. It's great.
Yeah, yeah. It just again, not to, I know we're talking about real estate here, but just curious, since this was really a foundational piece of kind of where you're at today. Curious as to who the buyer was. Was it a larger franchisee than you that ultimately was looking to gobble up more, or
It
someone
wasn't.
completely out of the network?
It wasn't. So what's interesting is I mentioned I have 5 locations. The story I shared with you was for the Omaha and Lincoln location. And that because that was kind of our flagship and that's where we live. I ended up spinning off the South Dakota location to our general manager who operated that business and sold the other 2 in Arizona to the general manager there, just because
Mhm.
it didn't make sense. So I actually had 3 different sales that were precipitated by that first one in Omaha, 3 different
Okay.
owners.
Got it. Got it. Well, that's very exciting. Congratulations. So
Thank
now
you.
now that's when we pivot, right? That's where we pivot the focus into real estate. What did that process look like?
Well, so this, to be perfectly transparent with you, Kevin, I didn't want to get into real estate.
Okay.
And the reason I didn't want to get into real estate because my perception was that I had to take care of tenants. I had to work on properties. I felt like the tenants were going to manage me, and I didn't want that. If you remember, I was talking about the franchise as an owner operated model. That isn't
Hmm.
what suits me. I was trying to scale so I could have more of an executive role and to be a leader and to be a coach and a teacher, frankly. And so the real estate to me seemed to me to be much more of an owner operator model. And it didn't appeal to me because everybody that I looked to was an owner operator. It wasn't until this accident in 2016 that you mentioned in the intro that I had this moment where, and let me give you a little bit of a backstory first. My wife and I, when I sold the franchise, I started a construction company. I was licensed as a general contractor when I owned the handyman business, so it was an easy transition. And we were doing retail, bath, and kitchen remodeling. We're also doing. We had at one point we were in 10 states. We had 300 guys, and we had crews all over the place. And in order to keep them busy, we'd buy flip houses, and we'd say, "Hey, this job is in between things. Go work on the flip house." So we could always keep the best talent, if that makes sense.
Hmm.
We also, my wife and I, because I had the hand skills or have the hand skills, would flip our own. So we're working on a house, 2016. It was July 4th. We get up in the morning. We have plans in the afternoon. I said, let's go work on the flip house for a couple hours. Let's get a few things done because we're behind schedule, and then we'll be done by noon. We'll go enjoy the rest of the day. We show up. The house was built in 1920, and I don't know if you've been in a house in the 20s or early 1900s with an oak floor. A lot of times that oak will separate, and we had just sanded it to be refinished. So it was all the pores are open. It's raw oak floor, cracks everywhere, and my wife is going to start painting some trim white, and she kicks over a can of white paint on this oak floor. So
Oh boy.
we spent better part of an hour freaking out trying to get this because it soaked it up so fast, and we're getting it mopped up. We get it cleaned up. And I'm like, okay, I just want to put one piece of trim up in the bathroom. I just need to feel like I did something. So when I leave this house, I don't feel like it was a complete waste of my day. So I go in, and behind the toilet, there was a piece of trim, and then it returned to the door opening. And that the wall that returned to the door had a little bow in it. And so the nail or the trim, when I was face nailing it, it wouldn't it wouldn't bite.
Hmm.
The plaster was too thick and the wall had a bow in it. So instead, I decided to push the trim in, and I toenailed the one piece of trim to the other so it would hold, and that nail came back, ricocheted, and went in my eye.
Oh my gosh.
Yeah,
Wow.
it was a 2.5 inch finish nail, 8 or 16 gauge. I still have the nail in my um, dresser drawer because it was a life altering moment. Um, anyway, so all of that to happen, we I've had multiple surgeries. I can't see out of my right eye because of it. But through the recovery of that, which I won't get into that whole journey, that's a whole nother podcast probably. But through that recovery, I couldn't work. And because and I don't know if you're familiar with well, just the practice of closing one eye and how it feels. You lose your depth perception. You can still see
Hmm.
fine, but your spatial awareness, my spatial awareness went away. I was knocking stuff over. I'm running into people. I can't grab a glass of water without knocking it over. I can't climb a ladder without sweating. And so I wasn't about to work around, saws and drills and things that could hurt me further. And that's when my wife convinced me, hey, you have all these skills. You can't use them, but your brain is still good. You built businesses. Let's get into real estate, and we'll figure out how to create a system and a process that allows us to be more passive. You can be more of an executive. You don't need to own and operate. And that's really the tipping point was that accident where I cast a new vision because I couldn't see, and
Wow.
we
What
started
a
buying
freak
buying real
accident.
estate. Yeah.
Unbelievable. Unbelievable. It's okay. Okay. I was not expecting that that would be the origination of that story. But no, so that's where we're at. That's where we're at today. Your wife, obviously very supportive, and ultimately knew that there was still great opportunity to be had, and that you just had to pivot to a different direction. And so, what did that? I mean, what did the passive world look like? Talk to me about that journey, and what I guess that maybe even that first passive investment to where you realize like there's an opportunity, there's a business here, there's a separate business, something that exists that I didn't realize before because I thought I had to be actively involved in these deals. I had to be the one swinging hammers. I had to be the one taking the phone calls, managing these properties, or having the tenants manage you as you had said earlier. So talk to me about the light bulb moment where it went off that like there's a completely different world out here that I didn't know existed, and I don't have to be the one swinging hammers or taking calls from angry tenants.
Yeah, that's right. No, I think it was sort of a two-tiered um, light bulb, I guess. The first was when I started to invest myself as a passive investor with other syndicators as a limited partner.
Hmm.
So putting capital in a handful of deals in Texas and Tennessee and Florida with other operators and getting good returns and not doing anything. Honestly, my wife and I basically took our retirement account and self-directed that and started investing that capital while we were doing our own real estate. Because I'm thinking, to your question, how do we do this more passively? Well, I realized that giving the sponsors money, it's a slower roll, right? It's a
Hmm.
5-year hold or whatever it is. And so what am I going to do in the meantime? So we also built our own portfolio. And it was the really the second part of that light bulb moment, which was the most pivotal, was when we bought an 88 unit building here in Nebraska. And it was a very interesting building. It was built, it's a dispersed site. So there's 4 buildings. It was built in the early 2000s, and it had never been maintained. So the guy built it, developed it, and the original developer still owned it, but it deferred maintenance like crazy. And so we were buying it at a deep discount. It appraised the day we bought it for right at 4 million. We paid 2.8 for it, and we had a seller carry of the majority of it. I think he carried, I don't remember what it was, Kevin, but he carried the majority of it because he was
Hmm.
not a seller. He was a don't wanter. He was like, I just need to get
Yep.
out of it. He was diagnosed with terminal cancer, had taken it through its life cycle, was exiting all of his positions. And so, to be honest with you, I didn't think we could do it because we had done several single family, small multis, and it's all value add stuff, right? So, because I'm a contractor, I like fixing things, and the value add play made sense, but I'd never done it at that scale. So we leveraged our own portfolio for the CapEx and got a line of credit. So we got $1 million line of credit against our existing portfolio and put our own money into it and said, let's just see if we can do this on our own. So we bought it. Um, I want to say it was in 2022. And 2 years later, we had completely repositioned the asset. We renovated 60% of the units. The rest of the tenants tolerated the rent increases without having to renovate.
Hmm.
And when we got it reappraised, it appraised at 7 million. And we walked away with not only paying our line of credit, paying the first position lender, paying the seller carry, but we walked away with a check for $1.2 million. Still own the asset. It cash flows 12 to $14,000 a month, depending upon occupancy, and is paying for itself. And I said, okay, now I know why people do this. And so we stopped investing in other syndicators deals and started to syndicate our own deals. And so now we invite families to come along for the ride with us.
Fantastic. Love that story. Yeah, it just takes that one, right?
It's
It
amazing.
just
Yeah,
and
it
it's
is.
I'm not going to say like you can't replicate that to a T every single time, right? But that was an absolute home run. I mean, and there's different levels of kind of, risk tolerance. Like one would say that was a it depends. It depends, how you want to place the bucket. But I would say a higher risk, but high reward because you're repositioning an entire community. I mean, like it had been mismanaged, deferred maintenance. You got some uncertainty made with the tenant base. Not sure how they're going to react to a rent increase and things of that nature, right? So there's some uncertainty there, but ultimately a high reward if you're able to execute accordingly, right? So that's absolutely a home run. And then you've got the other end of the spectrum, which is just buying, kind of core assets that are stable, not much upside whatsoever, A class assets that they're new, they're brand new or only a few years old and don't have any deferred maintenance, have A plus credit, tenant base that pay on time, 99.9% of the time, and very little risk, but also, the returns are much, much lower than what we're talking about here. So talk to
Well,
me about,
you're
yeah,
going to be
go
paying
ahead.
you're going to be paying a
And paying a premium.
whatever 4 or 5
Yes,
cap on
that's
those.
right.
We're buying stuff at 7, 8 cap because of all the
That's right.
work.
That's right.
So
Absolutely. So, well,
I'm
that's
sorry I
fantastic.
interrupted you.
No, no, no. That's fantastic. Again, I appreciate you sharing. So, your business today, you guys, you're basically finding your own opportunities, bringing other folks in, bringing capital in from outside sources, and running as GP on these projects. Correct?
That is correct.
Okay.
Yep. And so our basically our business model is we some of the things that we try to do a little bit differently. We do rely on brokers to source deals, but we've never bought a deal where we haven't had a direct contact and relationship with the seller.
Hmm.
In other
Yeah, I
words, the
think that's
broker,
critically important.
it
Absolutely. Even
has to be.
broker. Yep.
And I'll tell you that it's interesting how few, I shouldn't say few, how many others in our space are comfortable dealing with seller to broker to broker to buyer and navigating those transactions without having a direct and real conversation, generally multiple conversations with the actual asset owner, the management team. It just seems like it's way too risky to me unless we're having direct access to these sellers and can
Yeah.
talk to them and navigate these conversations, because we're not buying an asset, we're buying a business. And all those operational warts and challenges are really what we're trying to uncover in that journey so that we can see
Hmm.
where the opportunities lie for us to level up. We also
That's right.
interview every single tenant, which not all owners like, but it's part of our due diligence. Like, we want to know, how are you being treated and what are the challenges? Because they're the ones that are going to be completely raw. And a lot of times, you know, it's over the top because they might have some grievances. But we get a true picture. And
Very
so,
interesting. Yeah, I would say that's a first for me. While it's happened before, and it's more commonly it's happened in maybe other types of commercial where we're interviewing the tenants. Like if we're buying like in the past retail or office or
sure.
industrial, anything along those lines. And I would say pretty much any time other than when we've bought, either multifamily or, mobile home parks, which is what really our asset class is. I
Hmm.
can't remember a time where we actually had the opportunity to interview the tenants ahead of time. So that's
Yep.
great. I love that. I love that. But I could see the opposition from I could put myself in the shoes of a seller.
Of course.
Um, and understand the opposition there and the concern in the event that everyone gets freaked out, whether it be the folks that are running the building, the office staff, to every resident. Nobody likes change, whether you say you do or not. Like everyone still has a somewhat of an aversion, some higher than others, to change in general, right?
That's
And there's
right.
there's fear
That's right.
that comes from that. So,
Well,
but no,
I
great
think
great job being able to do it.
the key, Kevin, honestly, is collaboration.
Yeah.
And so much of what we do is rooted and founded in Chris Voss's teaching about,
Hmm.
never splitting the difference. And I highly recommend that book to anybody who hasn't yet read that. It's like one that I read every year. And I actually have co-authored a book with Chris that is an Amazon bestseller, which I was completely blown away and humbled by the opportunity to do that with him. So he's taught me a ton about empathy, about collaboration.
Hmm.
His skills as a former hostage negotiator with the FBI translate so well to the business world, because really the key markers about our characteristics about our conversations mirror that of a hostage negotiation so well, it's uncanny. There's really three things. One is the stakes are high. There's a lot of money on the line. The opinions vary. The seller thinks one thing, the buyer thinks another, and there's strong emotions.
Hmm.
They're oftentimes we're wed to our ideas. And so when you have those three elements, that requires really, really strong empathy. And if you can use the tactical empathy that he teaches, you can get to what I have coined the thin place. And that thin place allows you to really reach collaboration at a level that puts the seller in a place of comfort to actually say, yeah, please do talk to my tenants. because
Yeah.
he's now on our side of saying we're trying to facilitate a transaction instead of having this defensive posture and this traditional, hey, this is in between us and we can't see past this. So what we do is we move it over here, and now you and I work together on this. And if we can get to this kind of a relationship, now it allows us to do some of these things that are a little bit maybe different than what the norm is, because
Hmm.
we're not afraid if the transaction falls apart. We believe we're people of faith. We believe God owns everything, and we're just going to walk in faith and be stewards. And if we're good stewards and we can manage that relationship first well, then we're going to have more doors open to us as we do our due diligence, which reveals more secrets, which ultimately gives us a better opportunity to develop a business plan that we can actually execute on with fewer surprises, which in the end is what our investors want: risk
Hmm.
mitigation and returns that they can count on. And so that's just one example of how we go deep up
Yeah.
front. We
I
say
love it.
go slow to go fast.
Yeah, I love it. I love it. So let's fast forward. Obviously, there's been quite a bit of changes that have happened, and not just in the multifamily space, but just generally speaking. I mean, historical rise in interest rates in such a short duration. I think 13, 14 months. We saw such an extreme hike. We've got a lot of other factors that are weighing against just real estate in general right now. Devaluations. Some markets rents have actually gone down. Not sure if that exists where you're at, but ultimately, most of it's like Sunbelt states where we've seen, instead of the double digit, annual rate increases that occurred for a number of years. Now it's been a decline in rents in certain markets. But so I'd love to just get a sense from you. So like maybe I guess what's your business look like today, when compared to maybe 3 years ago prior to the rise in interest rates, and how are you navigating more specifically? How are you navigating some of the volatility in the marketplace?
Yeah, great question. So our business in the last, well, if you go back 3 years, it was fast and furious. There were a
Hmm.
lot of transactions. There was a lot of movement. Um, the rates being low obviously facilitated a lot of that. It was harder to separate really the good deals from the bad because the emotion was so strong, right? One
Hmm.
of those three things, right? There's so much emotion involved because there's a frenzy around real estate. A lot of people putting money in that maybe shouldn't have been. Um, but over the last couple of years, Kevin, we've bought almost nothing.
Hmm.
We are strictly cash flow buyers. Even day one, we won't we pref we have a pro forma and we have a business plan, but we say worst case scenario, we can't execute it for some
Yep.
reason. So how do we hang on to the asset if we can't perform the business plan? If we can't get the rent increases, we can't do the renovations. We have to own it as it is. That's worst case, no improvement. Can we tolerate the tenants? Can we tolerate the rents? Can we still cash flow? And if we can, then we'll make an offer and buy the asset. And for a season there wasn't anything trading. And so in the mind of the seller, prices were still high. And they weren't ready to say, hey, they've readjusted and said, hey, now it's time to move this asset at a more reasonable rate, which I think we're starting to see a little bit now. Some of it has to do with, the reason for selling. The last two deals, for example, that we've closed on are sellers retiring and getting out of the business altogether. And that's going to happen regardless of the rate environment.
Hmm.
So they could hold on for a few years and now they're saying, I'm done. Like I wanted to be done for 5 years. I should have sold 4 years ago. I didn't. Now it's back to where I think I can
Hmm.
stomach these prices and still find some good deals. But there was a season where it got pretty dark and dry for a while. And then you just start relying on operational efficiencies and trying to be better at running your business and not
Hmm.
so focused on acquiring more stuff.
Are you guys primarily focused in kind of your backyard, in the surrounding marketplace or have you gone outside of your market and outside of your state to buy deals?
No, we're buying in the Midwest.
Okay.
The majority of our assets are within an hour of Omaha
Okay.
because that's
All
where
right.
we have a construction company, a property management company,
Mm-hmm.
and all of our resources are right here. So obviously, if we're going to take down a deal that needs a bunch of work and has tenant issues, we want to have boots on the ground. And so, as kind of a rule, we won't buy an asset that's less than, well, I should say, it doesn't matter the number of doors. It has to have on-site management if it's outside of an hour from us. so that they can become part of our team and be assimilated into our processes. Because for our guys to travel that distance is just inefficient.
Sure. And then your sweet spot on deal size. I know you said any number of doors, but what have you found to be like your sweet spot? Because it sounds like your ideal seller is truly a mom and pop owner. Maybe it's not first generation, but you ultimately someone that's owned it for many years and might be aging out of the asset, looking to retire, but maybe has had a little bit more involvement in the business. It hasn't been completely passive for them, and they're just getting tired and worn out. Maybe that's not entirely accurate, but just that's what I kind of gather. But I guess what does that make the sweet spot to be as far as size wise? Like, what is your ideal size?
Yeah, no, I think you're spot on, Kevin, with your assessment. We call them tired landlords. Those guys are our
Hmm.
favorite to deal with, and whether it's age or disease or a combination of both, are repositioning their own assets. We've had um, owner operators that are now moving into triple net stuff where they were before, operating rental properties. So
Hmm.
but yeah, that's our sweet spot. And generally what happens there is the asset size is smaller. So we'll buy 40, 50, 60 unit buildings from these guys, and then they have two or three others. And so collectively we might end up buying 100 or 150 units from them, but it takes multiple transactions to do so. For example, the last two that we closed were the same seller,
Hmm.
and we had purchased a building from him previously. And so now that's the third building we're purchasing. We actually are going under contract on another 40 unit building here in Omaha from a guy that we bought the 88 unit building from several years ago. So we like the mid size assets. Ideally, you're buying them locally because of our resources here. And frankly, the competition is a lot less fierce on a mid-size asset than it is on
Hmm.
a 150 plus unit building where you're getting institutional money and a lot of more sophisticated buyers and sellers that aren't interested in collaboration. They're interested in transactions.
That's right. That's right. No, that's great. I'm glad to hear you had made a comment that you just really haven't bought that much in the last couple of years, but it sounds like maybe that might be changing. There's some things in the pipeline, things that are working. Again,
No
using the
question.
example of it sounds like you bought a number of properties from this one seller, and he's got this one remaining. You're about to go into contract with it. He's probably just been holding on for the last couple of years. Is not truly believing that his property is now not valued as what it was 2.5 years ago, right? Like
That's
probably
right.
much less per door than maybe what you bought his other assets for. And so, but now he's like, okay, well, this is not changing overnight. Things aren't going to get it better overnight, and it's either I kind of hold on for probably multiple more years, or
Yes.
I'm probably good enough. Like I've got enough.
Yes.
My lifestyle is
Yes.
probably not going to change if I take 5 or 10, 15,000 less per door, and I'll still do quite well.
That's
So
right. Well,
let's move
and
it on.
his priorities have shifted. That's very, very on point, Kevin, because his not only is his attention on these assets or his willingness to attend to these assets dwindling, his attention is shifting to other things. He just bought a multi-million-dollar house in Colorado and wants to spend more time. He loves to ski, he loves to mountain bike.
Hmm.
It's a 70-year-old guy and he's very active. And so yeah, he's now seeing himself in another phase in his mind. And this is more of a nuisance and more of like something
Yep,
holding him back. People don't always sell just for financial reasons.
that's right. No, I agree with that. So fast forward to today, or this won't be released, until after the election. But we're not going to talk politics really here. But I think more specifically, everyone's got their own opinion on maybe what the future might look like, at least as it relates to the real estate market and the economic cycle that we're in, and I guess what based on whatever your opinions might be, we don't need to go down that road, but I guess what are you most excited about here over the next year or two as relates to your business, growing it, or just anything in general related to what the future holds or what the future has in store?
Yeah, I think it's sort of a double-edged sword at this election, in my view. I think on one hand, if we get Trump, I think he's very pro-business and very stimulative to the economy. And I think it gives us some tailwinds and some favor for, I think, people to feel aggressive or comfortable, maybe not aggressive, to trade, to know that there's going to be some friendly environments related to business transactions. And I think Kamala on the other side with more stimulus and more helping the working class as she's promising to do, I think creates more challenges for the real estate market, specifically the single family space. How do houses become more affordable when you're
Hmm.
given buyers cash to go buy. I think there's some misgivings around how that actually works.
Yeah.
And it sounds to me to be more of a talking point, but I'm genuinely concerned if we have a Kamala Harris presidency
Hmm.
related to policy, related to regulation, overreach, taxation. Um, there's just a lot of things that have me and other small business owners that are in the same boat as I am, just wondering, how does this affect us? I mean, the one simple thing of taxing unrealized capital gains,
Oh, that's ridiculous.
I
Yeah.
can't imagine how how that would work. And it would disincentivize all of us from buying and investing. And so, again, I'm a person of faith, and I trust that God has a plan, and we're going to make money either way.
Yep.
And our well-being as a family is not hinged on who's in the White House.
Hmm.
But to answer your question directly, I'm definitely much more pro-business, pro-liberty. You know, get out of our way. Let us do what we think is best
That's
with
right.
fewer regulations. So obviously, which way I would lean.
Yeah, no, no, fantastic. And then as far as, rates, I mean, obviously, this time will tell what the Fed does. But I mean, it sounds like you're already starting to see, at least in your world where you're focusing on buying assets, it sounds like you're already starting to see just some lightening of, I guess, or I guess I should say, expansion of transactional opportunities, right? Just, deals
For
actually
sure.
coming to the market now. And I don't know if you're seeing the same, but I know that what we've personally experienced, we've had a great really last 2 years. But then again, we didn't buy a lot during 2020, late 2020, 2021, 2022. In fact, we sold quite a bit and did really well. And but then it really put us in a position when other folks couldn't buy or were dealing with damage control or debt maturities or capital calls, all these other things that kind of played out in the last 2 years. Things still came to the market. Not we'd have to look at like 3x the number of deals to find one that's still penciled, right? Trying to be
Right.
disciplined with our decision,
Right.
but we found great opportunities, and I think there's I guess the more of that story is that there's always opportunities, no matter what part of the economic cycle that we're in. I think you have to be diligent and you have to be disciplined. And if you stick to the underlying fundamentals, which they don't change, right? Like you just
Yeah.
the fundamentals don't change. And so long as you don't lie to yourself and you don't, just do a deal to do a deal, just to be a transactional based type of business, and you really have a bigger vision and mission for your company, I think inevitably you'll find success, both short and long term. So it just we're doing, things are going great in our business, and but it's opening up a little bit, which, yeah, but I think there's the flip side to that. There pros and cons, right? Pros are like more transactions, but also cons are might be more competition now as well.
Right. Right.
Especially if Trump gets in office. Obviously, it's he's pro business. If 100% bonus depreciation comes back, which I want more than anything else,
Of
you know,
course.
it just more folks come off the sidelines as well. So
Absolutely.
pros and cons of
Yeah.
whatever the outcome might be.
We are in the Midwest here. We're an ag-based economy, and
Yeah.
so we look at our our world through these seasons in not so much chronological time. We think more about, it's time to plant, it's time to harvest, it's time to cultivate, and those
Mm,
sorts of things. And I think that's sort of what the last few years have represented for us, where we've spent more time, working on the machinery, making sure it's ready. The harvest was over,
yeah.
and we had to bring everything into the barn and tear it apart and make sure it's ready to go and work on everything so that when the next harvest comes, we're ready. And I feel like we're poised for that. It sounds like you guys are too.
Yeah.
And that's a good thing, because we're going to be taking advantage of some opportunities that I think are yet to come through some of these debt maturities that you're talking about, and maybe some rates hopefully softening a little bit. Who knows exactly what's going to happen there, but some favorable things that should help us that are ready to capitalize on those opportunities.
Yeah, that's a great analogy, by the way. I love that. I can't use it again because I'm not a farmer and
Yeah.
I don't live in an ag based area, but like that's phenomenal. I love that analogy. So, Mike, for those that want to learn more about your group opportunities, where's the best place to track you down?
The very best place is to go to our website, freebyrealestate.com. I'm also very active on social, Michael Kramer on Facebook, Instagram, those sorts of places. But I'd say the very best place is to go to our website, freebyrealestate.com.
All righty. Well, fantastic, guys. We'll put that in the show notes. And Mike, it's been a pleasure meeting you, speaking with you. Appreciate the great insights and wishing you all the best.
Likewise, Kevin, I've enjoyed the time. Thanks for having me.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.